Hello and welcome to Finish Your Business. In our podcast, we leave no business unfinished. I'm your host, Namrata Sethi, and this podcast is brought to you by MEGE, which is a joint project with Haaga-Helia University of Applied Sciences, Helsinki Business College, Aalto University, and The Shortcut, and is funded by Udiman Lito. Today, we have two guests joining with us from Lifeline Ventures and Fiban. Samuli and Teemu, welcome to our show and thank you for joining us.
Thank you. Thank you for having us.
If you could please introduce yourselves.
Yeah. So hi, I'm Samuli Leppänen and I'm a partner and CFO at Lifeline Ventures. So Lifeline Ventures is a early stage venture capital firm located here in Helsinki. We have a team of 6, and basically what we do is we look for future category-leading companies with strong founding teams. Me personally, I focus on companies, especially marketplace and fintech companies, and I'm also the CFO, so I'm responsible for the financial side of our operations as well. Bit of a background, a lot of finance roles in corporate treasuries, banking, SMEs, companies like Microsoft, Nokia, and Everybank, before taking a little bit of a chance, I guess, and moving into the startup world, going to a sports marketplace startup in 2015, and was supposed to jump to another startup, but through some twists and turns, ended up in venture capital in 2016, just after we launched our third fund.
Yeah, right. So, hi, my name is Teemu Varpanen. I would say I'm a software geek turned angel. So I was in software industry for about 25-ish years, working in the both the corporates with the big projects, and also with the maybe a third of the career in the startup-ish company, meeting great people and doing great stuff. So I maybe about 5 years ago, I became financially independent, and after spending a couple of years with the Netflix and computer games, I was kind of bored to that, and did a bit of a soul searching that what I want to do when I grow up and with the rest of my life, and also with why and with whom. And because I really love the people in the startup community and the entrepreneur kind of a mindset and the kind of forward-pushing people, I decided that I want to help with the new companies and started kind of looking into the angel investing. And quite early on, I found the Finnish business angel network, Fiban, and it's a beautiful place to be as an angel. And it happens to be member-wise the biggest angel organization in the solar system. So it's quite relevant. There are richer ones, but no bigger ones. I claim so. So I was quite active in the Fiban and did some 20-ish investments in a few years. And my initial strategy was to network, obviously, because that's the most critical part of being active angel investor. And I wanted to learn the processes and tools, but also to learn the people whom I want to work with, and more importantly, learn to identify the people whom I don't want to work with. Even more important. So I have done about 20-ish investments. 16 of them are alive, and a few of them are doing fairly good. One hopefully is doing very good. One that we are hoping sharing with Samuli as well, and the Lifeline Ventures. And my kind of focus is B2B SaaS companies, which kind of relate to my background, because I can help with those companies with my previous expertise and connections.
Great, thank you. And what does entrepreneurship mean to you, and why is it important?
You want to go first, or I go first?
Well, I can continue.
Sure.
It's always easier to stand on the shoulders of giants. So I'm kind of copying from Janne Jormalainen, the previous chairman of the board from Fiban, and he said that he wants to build new companies so that when his children grow up, there will be more companies in Finland than the VR, the public railways, and the Alko, the monopoly alcoholic company. So he wants to bring new successful companies and successfulness to Finland for the next generations. And I can relate to that completely. But I also I think that the companies are the key for solving the big relevant challenges that the humanity faces. And I think that kind of a pressure to push forward and find the solutions for the big problems is extremely inspiring.
Yeah, maybe continuing on that sort of macroeconomic aspect of companies, totally agree. So studied economics basically all my life with a lot of interest, and companies are definitely the backbone of the economy. That's very clear. And employing people, but now with the current issues regarding sustainability and climate, for example, totally agree. We need the companies, of course, the infrastructure around it to help solve these problems. On a personal level, what entrepreneurship means, if I sort of think about it as a kid, to some extent, I guess everyone is sort of an entrepreneur with what they do. Is it at home or at work or during their hobbies? Because basically we're talking about looking at your environment, identifying opportunities and then solving them. So for me, like essentially it's problem solving to the extreme. And with startups, there's startup entrepreneurs who solve problems and try to make an economic profit based on that. And this is very much what it is. And if you look at that adjectives, what it means, it's passion, it's excitement, it's ambition, it's risk taking, and being a bit different, I guess, because you're taking a journey to the unknown, basically, for even serial entrepreneurs. So I'd say those are what it brings to mind, but naturally it's not for everyone. So it's a tough road, but that's okay. Not everyone should be an entrepreneur.
Sure. But maybe everybody should have an entrepreneurial attitude.
That's very correct. As I said, everyone's sort of an entrepreneur everywhere, whatever they do. But being a startup entrepreneur is that's a different ballgame, I guess.
Don't do it.
No.
And how does your organization help entrepreneurs?
Sure. So as I sort of touched upon briefly, we're a venture capital firm, and with currently approximately 230 million euros in assets under management. And of course, what we do to help entrepreneurs in basic sense is we fund the best innovations, fund the best companies, those that have great prospects. That's our task, and that's what we are excited about, and why we wake up and go to the office and look at new stuff. What we want to do, I guess, a bit differently at Lifeline Ventures, but probably more venture capital firms should do as well, is really form a sort of a very tight bond with the founder. So this is our way of helping companies and their founders. So in addition to the funding, be the closest advisor to the founder when building a product. We're very much sort of focusing on early stage investments. So is it angel, pre-seed, or seed investments, however you want to classify them. What we usually do, and we invest in companies before they have significant revenue, before they have found their product market fit, meaning that they have found customers and the market finds the product or service attractive, and sometimes even the company doesn't have a product yet when we make the investments. So we have a great track record and expertise within our team from different industries to help, and we have the knowledge to help these founders to actually understand what needs to be done for this company to reach the next phase, meaning that you're actually being, achieving some sort of sales with your customers. And this is very much what we do. It can be connections to some other parties, helping with recruiting, strategic role, board work, a lot of things basically. But we really want to be the first person a founder reaches out to, in good or bad times.
Right, and I guess kind of angel investing, like Samuli mentioned before, it's a bit overlapping because some of the companies are within the scope of the Lifeline and other VC ventures, and others maybe less so. And so I'll kind of maybe I'll explain the process from the Fiban perspective, how that works for the companies seeking for funding and advisors. So the Fiban serves the startup companies by having this kind of a deal flow, a funnel that enables them to pitch for funding, but also for knowledge, expertise, and contacts and so forth. And the process works in a way that you submit the application from Fiban.org, I think. Hopefully I got the address right. And the first initial process is a slight screening by the Fiban office, where they check that all the relevant information is there and it's kind of a legit, right? And the next relevant phase is that we have a bi-weekly angel kind of a powered screening meeting where a bunch of angels from half a dozen-ish screen the companies, 20, 30 companies, and select roughly 1/3 of those to go to the pitching event that is happens about 8 times a year, typically kind of a 1 month apart, except for the summer and the right after the Christmas. And from roughly 1/3 of the companies that go on stage and pitch get funded. And typically the funding process, it's clearly kind of a described process and so forth. Typically it happens as a syndicate, which means that there is several angels having different kind of backgrounds and expertise who are interested about the company, and they come together and assess the kind of investability of that company. What is the business case? What is the problem that they're solving? Are they addressing relevant market and so forth? And most of all, is the team able to execute the plans that they're putting forth? And then they do an investment plan with themselves, and then negotiate with the company that what is the actual round size and the financial terms, the pre-money valuation of the company and so forth. And typically there's quite good data on the fiban.org/data, right? But typically the companies are pre-seed seed stages, so this is about 60% of the companies, and the funding is around 100 to 200,000. So you don't fly that far with that money. But when we are in Finland, there are several public money instruments and bank loans that you can use to multiply that money to about twice or 2.5 times. So that helps. And if they are doing their kind of a stuff right with this money, hopefully they can go to the next level and maybe talk to the Samuli and other VC kind of parties to get a bigger funding round with the bigger goals and so forth.
Okay.
So that's how it goes.
All right. And at what stage should they come to you? Like what stage an entrepreneur can come to you?
Maybe I start because I'm kind of a bottom of the well. So early.
Yeah.
And sometimes the team can approach the angels and pitch even before they have actually established the company. And there are some benefits to that. And there's benefits to come as early as possible as a company age. But I would say that perhaps the optimal place, the moment to come to get money is when you have the team in place, or at least most of the team, because that's the most critical part. You have stated some kind of a problem that you're solving. You have understanding about the market size, and you have a kind of understanding about your solution and the market demand fit, early product market fit. And optimally, you have first few crazy customers that are actually paying for the product, because this proves that somebody is willing to pay for your product. So there's a kind of a theory that lots of companies would be paying for it. So that's the stage.
Yeah, for us from the VC side and from our side, Ever since Lifeline Ventures was founded 11 years ago by Timo Haapelto and Petteri Koponen, the mindset has been the same. So our goal is to be the early investor or the first institutional investor in every significant startup that arises from Finland. And what this basically means that as early as possible, there is no is it too early or is it when can I go to Lifeline Ventures? We want to invest early, but of course we want to invest in teams that right away are capable of knowing what to do with the money right away and going to solve the problems within the product or the industry right away. But first institutional investor money, of course, means that it's quite a lot of criteria what we look at. A lot of the same stuff that Teemu mentioned as well, and of course because we have bigger funds, there are slightly different economics involved, which I believe we'll get into maybe in more detail. But there are a lot of names thrown around. It's angel, pre-seed, seed. Sometimes it's very hard to understand which is what. But early stage investing is all of those, and what's common to those is that it's usually before you've proved you have the product market fit, and all early investors are taking a risk, and that's what we love to do, and we always want to highlight this to the entrepreneurs we meet, and in the events we participate, that we really want to be the first investor in a company. But of course, sometimes there are angel investors involved, and which is of course not a problem at all, because we have value-adding angel investors often involved in our rounds as well. So there's always a specific role. A VC is more of an institutional player with a vast network and maybe some more tools to offer, whereas angels have a specific expertise and work experience or founder experience in a specific sector, which can be super valuable for a founder.
Maybe one comment that, what do you think, Samuli? I read these statistics that 90% of the first VC investments are done to a companies that the VC has been following for a year or more.
To be honest, that percentage sounds really high, but I know this is the case to some extent, but then again, it really
maybe
much
not for you.
Yeah, it depends on the VC, because of course if we have Series A, Series B venture capital firms which basically invest a bit more than us in companies that have more traction in the market, of course they followed them for a very long time. Whereas we have more of those cases that we identify a team, a serial entrepreneur, young entrepreneurs, a great diverse team, and we know they're on a project. If we get to know them well and we form a great partnership, we can do an investment within a month. It's just that we get to know each other, and we know there's a great opportunity there. So I'd say for us, it's the other way around almost, that we do invest
bigger funds with
exactly. So we do make the investments where we've followed the company maybe for a year or two, but I'd say the majority of the cases we do because we invest early. It happens quite soon to sort of finding out about the opportunity.
Good points.
And how does the angel network work?
Okay, maybe I get this.
Yeah.
So I kind of briefly talked about it earlier, but it is the angel network that brings the biggest value for the kind of any angel investing landscape. So early on, it's of course when you start to building the network, you have to walk the walk and also do the talk the talk part. So you have to get involved with the process and kind of portray you as a person and your kind of processes and know-how and so forth. And quite early on, at least for me, I was happy and privileged to connect with the top names in Finland in this space and in Fiban space. And once you have built the trust, and I think the trust is the critical part of any angel investment network and investments overall, of course. When you have the kind of a trust and you know the logic of the other angels, how do they work and what they value and what they think and also what they do not think, then you can kind of build the puzzle that what is the best fit for you and kind of have this extended group of people that you can easily relate and you can get kind of a good deals from there. And if you have a good deal, it's very easy to get other angels to get involved and kind of assess the case and maybe invest with you and so forth. So kind of participating with the angel events, and there are huge amount of events, even with this day and age, that you can network and connect with other angels. So, but you have to be active, of course.
Yeah, and maybe to comment what we've seen in the past few years, now with more and more entrepreneurs in the space and more experience about startup investments that angel investors have. The angel investor space is so much more experienced and vast nowadays. We actually we're seeing now currently a lot of former entrepreneurs.
Yeah,
they're able to make angel investments because the ecosystem in Finland, we're still very young sort of startup ecosystem, but we've reached the next phase that we do have more serial entrepreneurs and those are coming to the table and as well and offering their help and willing to invest more money in the startups, which is great.
Yeah. Those are probably the best because they have the experience, money and the connections. So
yeah. And how can you join Fiban as an investor?
Just apply in the web page.
Okay.
So, but there are bit limitations. There's a small joining fee and yearly fee as well, obviously. But also 2 reference people are required. And you don't want to in any way to be any kind of holistic club or anything like that. But because of the profile of the typical angel, they are also very kind of want a target audience for any sales guys. And we want to kind of keep this kind of close, relevant people there. And we don't want anybody to kind of come in and start selling aggressively some stuff to each other. That would kind of ruin the trust and the network spirit. So basically having a couple of references and just join up. Maybe the kind of optimal background is something like having a long business career with the kind of expertise and know-how in some specific areas, or like somebody mentioned, having the kind of entrepreneurial background, having maybe exits and experiences and stuff like that, and you want to kind of give back the money, which is less relevant, but your kind of experience, contacts, and know-how, which is more relevant. So that's how. And I definitely recommend that because there are quite extraordinary people there, and it's very difficult to connect with so many great people at the same time.
Yeah,
so
that's true.
Come on in.
And how does venture capital work?
Well, that's a big question. Just to summarize, maybe there's 2 sides to venture capital. So our venture capital firm, we get our investors and then we make investments in startups who are looking for investors. So maybe to summarize in 5 stages, how it all starts is we as a venture capital firm, we have to establish a fund. And to establish a fund, we need to get our own investors. And for example, our latest fund launched in 2019, had a size of 130 million euros. And basically the majority of that money comes from pension funds, family offices, government entities, funds of funds, so basically investment companies and insurance companies and other types of asset managers as well. Now, when you've done this fundraising for a fund, and these funds usually last 10 to 15 years, They have an investment period of 4 to 5 years. So every 4 to 5 years, a new fund is established, and then you have more, monetary firepower to do these investments. But now you have the fund, and now you can go and invest in startups, which is what we do, of course, on a daily basis, assuming we have the fund in place. And there, it all starts with deal sourcing. So through different avenues, is it the networks you have in place, an email, or just personal meetings or events? You look at different startup possibilities in different sectors. Of course, it depends on a VC, what they do, and what stage, what industry. For us, it's early stage and industry agnostic, basically. After deal sourcing, if you like the case and fulfills the investment criteria and passes the due diligence, some cases it's very light, with some bit heavier. Then you make the investment. So that's the sort of the investment decision phase. And after that, it's about ownership activities and monitoring your investment. And for a venture capital firm, usually it means that you appoint a board member from the venture capital firm to the company. And that basically means that it helps you being an active owner. Help the company, help the founder, understand what's going on, have the shareholders' interests in mind, as well as your own fund's interest in mind. And in addition to that, which is super, super relevant for us, is in addition to this formal role, you want to be a close advisor to the founder. Especially for us, we invest locally here in Finland, and is where we believe we have the most value. And try to stay very close to the founder and form a good partnership. So he or she seeks advice, and we're able to help there and help with other connections as well. And of course, we're learning at the same time there as well, especially with new emerging industries. That might be the case every now and again. In addition to that, active ownership for us also means that we're able to make follow investments in companies. So assuming we invest 500,000 in the early stage round, and then there's the next round, maybe with a new lead investor, then we would do our share of this so-called pro rata investment. Might be 1 million, might be 2, depending on the funding round. And this is very much part of our ownership. Not all venture capital firms can do that. But for us, it's very much our investment strategy. And then, if you will, the end of the cycle, of course, our duty to our investors and what the founders also want and the shareholders of the company want is you try to monetize on the economic potential of the company. So this can be an exit, so an initial public offering in the stock exchange. It can be a trade sale to an acquirer. It can be a majority stake sale to a private equity house, to another investor. Or then the company just becomes really super profitable on its own and might be able to distribute dividends. But at some point in time, a venture capital firm has to exit and sell its stake, because our funds, as I said, they're 10 to 15 year old, the term. So at some point we have to exit the business and realize our investment, and it's a very long road ahead before that, because our average holding period in companies is let's say 7 to 8 years. So it's not something you can think about, or the founder should be thinking about when you do the investment in the first place. But at some point in time, that exit happens.
Maybe complementing on that, I just heard a comment from lead angel in Estonia, who said that the investment period in the startup company is longer than the average marriage. So pick your investments carefully.
So can you tell us a bit about your investment criteria and the investment sizes?
Yeah, maybe I can continue because
Yes,
sort of
please.
talked about that a bit. So I guess the most important investment criteria could main five now. And so number one, we look for a company that's potential to be a category leader in its space. Number two, there has to be a unique competitive advantage. Number three, the market has unlimited characteristics. Number four, at least one, preferably two, of the founding team has potential to have a sustainable leadership role in the company, even though as it grows. And number five, in an economic sense, we look at companies that are able to return the fund, basically. I'll just touch on those five aspects quickly. So category leader, what it means is that the company can actually become number one in its space. Based on our experience, because we take a big risk with quite a substantial ticket investment size early on, we really want to see potential for that company to be number one. It's always going to be a tough road ahead if you don't have those blocks in place that could make you number one in that segment. That's connected to the second one, so unique competitive advantage. There should be something that makes it tough for a competitor to take your position. So some barrier of entry. It can relate to the innovation. It can relate to the team's technical skills, execution capability, or just the market position or market characteristics of that specific space. Number three, I was talking about the third one, the sort of unlimited characteristics of a market. What this basically means is that usually what happens, a company has some sort of projection for the market, and what almost always that shrinks. So you look for something that's very big already. So there's a lot of potential there because you're going to have to sort of iterate your business and find the right customers and find the right demographics there. So you want that to be super big already, and preferably with customers that are growing themselves. So there's a solution that there will be even more need in the future. Founding team is super important. What is important is that hopefully at least the CEO is a great leader, has the relevant skills to be in that position for a very long time. Because at the end of the day, we're talking about the product and the innovation. That's basically the founding team has been responsible for and what they've created. So you really want that so that they can realize the vision. Of course, you have to recruit the best people, but you hope that these key people can be those that are in it for the long term and are capable of that. And going to the economics there, I mentioned the fund returner. It's how we work, how the majority of venture capital firms work. So normal fund makes 20 to 30 investments, a lot of investments, and they know that perhaps not a majority, but a lot of them will fail. So they look for their sort of the profits. And those are derived from a few cases, and you want those few cases to be super successful. And for us, it means a fund returner. So as an example, a fund is 50 million euros. We would want that in the best case scenario, this investment returns 50 million euros to the fund, i.e. meaning that if there's a 500 million sale to a trade buyer along somewhere into the future, and we hold 10% of that company, so we would be getting 50 million euros for a fund. That's sort of the economic criteria, minimum criteria, what we would be looking at. So maybe those five are, I guess, they're a common theme across all of our investment decisions.
Yeah, well, pretty much the same stuff.
Yeah.
Obviously, maybe the kind of a logic of because this is extremely high risk investing. So typically the companies, with few exceptions, they are not generating profits. Their revenue is quite low. So they're basically burning money every month for several years before they become profitable. And this is called the valley of death. And it's quite typical for the startup. And in the kind of angel logic, if you make 10 investments, 5 of them will fail one way or another. Out of the 10, maybe 4 will be somewhat successful. And you aim to find that one that actually pays the rest of the investment for all of those companies and returns your profit. So it's a similar logic as with the VC part. And maybe the risk factor is even higher with the angel investing because you go even earlier than the early stage VCs, even though the Lifeline is kind of in the similar space. Regarding the investment criteria, and one more thing, if you do angel investing, you cannot know which one of the companies will be successful. Even the best angel investors in the planet don't know that. So the only way to handle that risk, kind of a risk-profit relationship, is to have a portfolio. And roughly 15 to 20 companies starts to be sufficient to equalize the risk-return profit model. So that's quite relevant. Investment criteria, it's very, very similar that obviously that Samuli has there, but maybe kind of looking from my perspective, it's the market size, right? And you have to have the actual problem that somebody is willing to pay. And the early traction is a good kind of a proof of that. And then you have to have a team that can grow. And like Samuli mentioned, that in early companies, it's a very different kind of a company than it will be already in 2 years from this moment. Because if you triple your revenue 2 years in a row, you're basically a tenfold company in a couple of years. And it's a massive change for the company and the team and so forth. So ability to scale the business model is difficult, but ability to scale the people, their mindset, the way of working, it's much more difficult. So kind of having a background and kind of experience in the business world or former companies is quite a kingmaker in this case. And otherwise, of course, the kind of same logic of being able to grow the company in that market space and having that same kind of a defensibility in the business is quite critical, because it doesn't make sense to bring new innovation and make it profitable, great company, and then comes the competition and wipes the floor with you. So you have to have some kind of a edge there to protect your business. But I think there's a kind of a fairly common understanding that the team is the key to any success, because the B-level idea with the A-level team will be a successful company, but otherwise, other way around, it won't be. And quite often, if the team can make a great product and great company initially, they probably can, if there are problems, do so-called pivot to turn the business around and make a new innovation. So the teams can innovate business, but business can't innovate people.
I think it's also important. We're talking now from the investor side of things, so angel or VC. But personally, try to have an entrepreneurial mindset in everything, even when investing. So it's important for the founder to always have as well some sort of own criteria regarding investors as well. So all investors are different. Some people, some firms, they are value adding, some not so much. Some have different specific set of skills and different criteria as well. So not everyone has the same criteria as us. And it's very important for, of course, it's good to be educated regarding what investors usually look at. But it's never wrong to try to find out really if that partner is right for you. Are your interests aligned? Are you a founder who's looking to grow super fast? Because if you're looking for talking with an investor who needs a high growth company, but you're looking sort of maybe at a different way of pursuing your entrepreneurial goals, there's a mismatch there. And at the end of the day, an investor becomes an owner in your company. So is it, a couple of percentage points with smaller angel investment tickets, or a big VC investment that we might do, and all the way up to 25%? they become a big owner, part owner in the company. So the best you can do is find the right partner. And that applies to us when we look at founders and applies to founders when they look at investors as well.
Yeah. So like what would be your ideal investment opportunity?
Maybe I go first. Well, looking purely from my kind of a personal space, it's a B2B SaaS company with early revenue, low valuation, cheap, right? That has a great team that has experience in that area, and they are addressing a market that is global, and they have a defensible, like we talked before, defensible product solution market fit kind of a thingy there, and they are hungry and able to grow that market to a bigger scale. When we are kind of talking about the Finland as a kind of a country and market, this is basically a polar swamp in the corner of Europe, so it's not a relevant market at all. And the most critical part for any business to go successful from Finland, they have to go abroad. And the ability to do that first leap and have those so-called foreign customers is one major success factor. But B2B SaaS company with a good traction and great team.
Yeah, probably a lot of overlapping things, and maybe talk about the investment criteria, which basically always need to be fulfilled. But maybe a couple of points just regarding the team. It's you can't stress it enough that there has to be some specific aspect about the team which makes it probable, or at least there's great potential for it to realize its vision. So it can be a serial entrepreneur. It can be a team with sort of a diverse set of domain knowledge. It can be a very young team, but so that they have attachments to the entrepreneur community, and they've seen how things should be done, and are super hungry and know they have identified an exceptional place. Maybe, of course, you in an ideal case you look at the company who has some sort of traction already, and there's evidence that the business model could be scalable. You can easily write that on a spreadsheet, just model the customers that you can really easily name and the number of end clients within that organization, and all on paper. And when you discuss with the team, it feels like when you invest this money, there's a clear path where that money should be used, and it will, at the end of the day, it's the point is to grow the business and fund the business, grow it faster with the investment money. And when you have this model, a scalable model with traction, it makes it very attractive. Maybe, and of course, we want to do good as well. So looking at later things we've done, which is relevant, a climate tech investment would be great, a diverse team, a founding team, which is, we don't see enough of those.
Yeah.
All these would make an investment opportunity even better.
And what startup shouldn't do when they are approaching you?
What they shouldn't do. 3 things come to mind. So number one, because there's is it now what it's been with Zoom meetings maybe, and or seeing people in person physically. Hopefully we get more of those as the spring goes along. But the pitch, the presentation to the investors, whatever you do, how you interact, it cannot be too rehearsed. It cannot be too planned, because the investor will always ask specific questions, try to really drill down and find holes in the business model, and try to understand what the founders are like, what's their story, how the business was built initially, how ambitious are they, what's the excitement and passion level there regarding the business, and the will to be it in the long term. I find it's very hard to rehearse that stuff. If you're passionate about your project, you will know how to present it. Of course, some people are worse at storytelling and presenting, but those skills will come along when you do it more. But what holds you back is if you're too rigid and keep the same story and are very inflexible. That's one. Number two is don't rush it. Don't have a specific timetable in mind. You don't want an entrepreneur to set a definite timetable for an investor that, within 2 weeks we get the interested parties. Within weeks 2 to 6 we receive offers and then we close. No, that's not what we want, at least. So we want to get to know the founder. It can happen within a week. But there's a lot of discussions, a lot of hours spent with the entrepreneurs. So, as I said before, you're giving a big chunk of ownership and you become partners. You want to know that your vision is aligned and you get along with each other and you're able to be really direct with the feedback and whatnot. And maybe the worst one perhaps is that a founder thinks about the exit already at the early stages of a company. So, of course, for an investor, there is an exit moment in time. But when we're talking about an early stage company that's still, learning to be an entrepreneur, building a product, finding the customers, trying to understand how to recruit the right people, there are so many challenges that if you're thinking about cashing in already, and even worse, saying that you'll do it within a couple of years, I'm planning for it. That's a red light. That's a red flag. That's never good. You want those that are passionate about the product and building a business, not those that are thinking too much about money already in the first place.
Okay, from the angel perspective and kind of talking a bit about the numbers. So when I'm kind of an active phase of looking for new companies, I go maybe 500-ish companies through a year. Some of them very lightly, and some of them I spend days with. And I invest to about 2 to 3%. So that means that most of the companies I want to invest that come to me, and the company the team and the company has to stand out quite way high from the crowd. And there are probably companies that have been great, but have not been able to present them well enough. And it's kind of depressing if a startup company or team approaches an investor and they haven't done their homework. So if an investor, I can spend 5 minutes with the Google to find what are the key elements in a good pitch or good pitch deck, what things should I have there and so forth. If I can do that in 5 minutes and the team hasn't spent that 5 minutes, then it's a signal that they are completely unprofessional, or they are very arrogant, or they don't have any skills at all to grow the company. Because if they can't do that, how on earth could they handle the next 2 years of the roller coaster ride? So that's not going to happen. So do your homeworks, then do them again. Practice with your dog and with your wife and your mother and whatever. And after you have done that 20 times, then come to the angels and so forth, and learn from the others and pitch. And when you have done it a few dozen times, then it's almost good. Then you can start working on it really. So practice and do your homework. And kind of relate to that, it's quite easy to build a model for yourself that what is the value of the company, how much money do you need, and it's quite important. And what do you need the money for? Where are you going to be after that funding round? Because you already, when you're funding, kind of applying for the pre-seed funding, you have to think at least the next stage and even the stage coming after that. So you have a kind of a plan that is viable, and you don't kill the company funding and the team with the initial funding round. And I think one of the kind of a typical mistakes for the team hopefully not typical, but I see those that at the first investment round, they give out too much equity from the company. So the team should retain control and large enough portion of the shares, the huge majority, so that they can be funded further on. And they should, I think somebody could go on for days about this, but they should have a significant or sufficient ownership so that they can be funded in the future as well. So you have to build a track, and this is just the first step.
Okay.
So the homework.
And pitching.
Pitching, yeah. But practice it, yeah. Hit the dog.
Yeah. And what kind of role equity investors typically take after investment, like mentoring or board work or introductions?
Yeah, I guess there's, as I mentioned, board work is, more often than not, it's a part of what we do as a venture capital firm. So basically, when you're on the board is responsible for basically guiding the team, guiding the CEO, and looking after the interests of shareholders, which an investor always is. And it's the best position to be in to get all the possible information about the business. But specific to, of course, us being an early stage investor, and what I'm sure Teemu will continue on, is that you're very close to the founder right from the get-go after the investor. So hopefully the founder wants an investor that can help him or her with specific things. And this is what we want as well, and want to invest in the cases where we bring value add. Is it the specific industry? Is it the specific stage of the business? Maybe the potential connections with the best possible recruiting channels or key people or investors. Just being very, very close to the founder and being his or her closest advisor. I guess, I think I said it before, but for us, it's about having a founder mindset in everything we do. So even though we are VC investors, and there are specific things involved in being an investor, and some things, you have to look specifically just from that point of view. Our mindset is very entrepreneurial, and that means being close to the founder. We don't have an operative role because we're not an employee, but we're an investor. So there's a lot of strategic advice. Is it board work or not away from the board meetings? These are super, super important when building a business.
Yeah, I guess kind of a similar stuff than Samuli has there. So the board position is, I think, the typical position to be in. And looking when we, as an angel group, the syndicate does the investments. So it's typically the lead angel kind of running the show that takes the board position, and there can be one or two angel kind of supporting otherwise the company with their knowledge and so on. And if it's a kind of a balanced network, you don't have to be in the board of every investment of the company that you make. And sometimes you can't be, but you want to kind of distribute the workload as well. So for example, me having 16 companies, I'm active in 3 to 4-ish, and I spend about 20 hours a week on those companies. And there are days that I spend 20 hours a day on a company, but hopefully that's kind of a exception. So kind of helping you to go on with the company, and in some companies I am in contact to them several times a week, and with some companies once a month or something like that. So varies quite a bit.
Yeah, it's good to recognize the vast amount of knowledge and experience the best investors have. So like Teemu said, a lot of cases, a lot of experience. We have made approximately 100 investments as well with a lot of active companies and great success stories. So it's perhaps not only what we've learned as investors, but there's a lot of this intuitive knowledge there, and of course a great pool of other founders and connections to be made within the ecosystem. It's not all about the connections, but I'd say that the journey, there's so many unknowns ahead that you really want to surround you with the people who can share those experiences.
Maybe I can kind of supplement on that, kind of riding on Samuli's note there, that now having several companies, it's quite valuable to connect the teams to each other, so they can learn from their successes and then of course the mistakes, and kind of speed up the things quite a bit. So kind of reusing the experiences and the connections and the solutions in the other company, it can be a massive help.
Exactly, and it's you can talk about this a lot, but is it the board work or the connections to specific angel investors or the knowledge of the investor itself? The strategic aspect is very important, because being a founder, being an entrepreneur, you have so many things on your table that it's very hard to maybe lose your focus, lose the sense of direction where you should be going, how to spend that money, look at the sort of bigger picture of things. That it's you need this advisor in the majority of ventures, at least.
So now this brings us to the last question. What advice would you give to an entrepreneur in 5 words?
5 words. Focus, learn, and recruit well. That's 5 words, I think. So focus is so important. Even a lot of experienced entrepreneurs say that's how tough that is, because basically you're facing an uphill battle against potentially competitors that have superior resources to yourself. You have so many unknowns, you're still learning, so that when you do the things, you need to know how to, focus on specific things within all that chaos that's going on. Because if you can't do that, you're doing 100 things, but you're doing, even one of them, well enough. So learning to focus and what skills are required, that's super important. That's going to take time, of course. Learning from those mistakes, because you will make mistakes when you're an entrepreneur. But assuming you're the correct entrepreneur who takes risks, it's trial and error. So you just have to learn from them as quickly. If you can iterate, even quicker, all the better. And then recruiting well. Is it partnering up with the right founder right from the get-go? Recruiting the first employees, the next set of employees. Take the time there. It's the hardest aspect, probably, of HR. Is super hard, and the majority of startups struggle with that. Luckily, we have a great pool of talent in Finland currently, who's even more interested than before to be working in a startup. So there's a great market there. And of course, sometimes you have to do some additional work to get the person you want in the team. But what is for certain is that if you make your decisions perhaps too quickly without proper background checks and really knowing the person, it will backfire more often than not. So find the right people, definitely. The team is everything.
Okay, this was quite hard. So I was kind of thinking that maybe the most relevant advice is that do not become a startup entrepreneur, because that's crazy stuff. But but if you are already on that path, or you kind of are committed, then I think learn, execute, team up, be nice, and learn. Because when you kind of dive into this kind of a mud pool of doing this stuff, you instantly realize that you don't know anything. And when you have learned enough, then you realize that you were right, you didn't know anything. So it's constant learning, and it's very hard learning curve. So you have to execute, do stuff, learn new things, and kind of repeat the vicious cycle of that. So learning is critical, and in connected to that, you have to be you should be coachable. So you should be able to take other people's advice without kind of feeling bad about it. That's a superpower. And team up. Nobody is a superhero. Everybody needs team around them, and they need to be aligned and have the same values to kind of minimize the friction. You can't remove it, but you can minimize it. So you have to build a team and think beforehand what kind of a team and what kind of a people do you want, but you need them. That's for sure. And the kind of related to that, be nice. So if you are, I will use the word asshole because Elon Musk uses it. So nobody wants to work with those. So if you're a nice person, it's so much easier to connect to the new team members, the funding parties and everybody else. So be respectful, give back and be polite and so forth. And of course, it is business. It's not a hobby. So execute, get results and kind of and then execute some more.
Yeah.
And when you are through that, you come back to the learning because when you go through that, realize that you have to do all of those. You don't know them, you have to learn them. And when you have mastered that in 6 to 18 months, you have to learn it all over again because the setup has changed. So
True. It's a round cycle.
It is. And it's a vicious cycle, but it also can be the greatest thing that you ever did.
Exactly. But I guess this is not advice, but what all entrepreneurs really should have. They should have the most curious mindset, possible, because it's gonna be trial and error. It's gonna be about learning, doing stuff on your own that you never thought you would be doing. So, more you are curious, the better, and you'll sort of, conquer these challenges much more easier.
Yeah, and have no fear.
True. But thank you so much for joining us and sharing these insights and
Privilege.
yeah. Thank you.
Great to be here.
Yeah, thanks.